Well, hello again, folks. Glad to be back. Exciting times, depending on which side of the market you're on. Lately I've been talking to my students and clients about the stock market did not look that solid to me. Even scared me a little bit because it wasn't giving clear signs of reversal. It did give volatility, which is one of the signs of usually intermediate reversal. And I've noticed a lot of people, Twitter and other people who have written to me individually asking about my range rules. Well, today I want to talk to you about range rules because they're showing signs that we're in the process of reversing, possibly in a big way. But the leader had been the NASDAQ. And if you see here, back in November, we hit a peak, the middle chart, and the RSI created a little divergence. And it sold off. My moving averages of RSI turned down. And then we had a rally again, a slightly higher high back in at the end of the year, but it never went above 60 and turned down. And when that moving average turned down and the RSI crossed it, they both fell together to a low on the RSI down around 40. Well, that's the bottom of the range. It actually got down, the RSI actually got down to 25. So it showed signs that the range was shifting, not being able to get above 40 on the upside, and then turning down and breaking 40. That tells me that most of the momentum is gone. So it was going to continue lower. And I was a little skeptical. People were saying, well, it's way overdone. I said, the range has shifted, the moving averages are down. I said, we're going to go lower, and we did. Then we started putting in some bullish divergences and had a rally. Everybody was impressed by the rally. But bear market rallies can be swift, and they can also be very scary because it looks so good and it looks like it's turning back up, but it can go to 60 or 62. Even here it went to 64. But then let me zoom in a little bit on this latest top. If you notice, the RSI got up here to 64. The price got up to 15,239. 1, 2, 3, 4 days later, it tried to rally again, but it only got to 61. And then the moving average 9 went flat. It started to turn down with the RSI again. My CFG at the bottom gave a clear sign of a divergence. And then I've done moving averages on the my CFG 20 period, which is the blue line, and then the red line is the 45. But when it crossed, that 20 crossed the 45, the RSI had already crossed its 45 period moving average. Had a couple little rally attempts, and then we had another one recently, yesterday, with what I refer to as a head bump, where it bumps its head up against the moving averages and turns down. So pretty much it's fulfilling all the signs and telltale signs of a move much lower. And I think the start of maybe a mini or intermediate bear market. And I hate to say that because it bothers people, but you can make money in uptrends, you can make money in downtrends. But this one has shown it wants to go lower, and it was the leader. Here's the Dow Jones. It really couldn't get above 60. So the NASDAQ, the S&P, they all seem to be turning lower, and I've stayed positive on commodity prices: crude oil, gold, silver, cotton, wheat, corn, soybeans. I think cocoa is getting ready to go. And I've been saying for a couple of months that this year we're going to see more action in the futures market and commodities than we're going to see in stocks. So I think they're starting to run opposite, and would not be surprised to see some numbers of commodity prices that will surprise you. We've already seen it in crude oil. It's gone from under 50 to where it got up to 120, 125. I think it's headed back that way again. We get over and we'll pull up some commodity prices. I still think probably gold, my targets are up around 2250, 2400. Silver, $40 to $50. Look at the crude oil. These pullbacks that we had from those last highs only came down to 45, and then another turn down, sold it off to 42. Now we're starting to turn up again. So I'm still maintaining a longer term bullish idea. Coffee has been one of my favorites. It's had some sell-offs, but it's pretty much staying above. There's 37. And over here, we're at 40. We had that one rally to 60. So I think we're going to start another leg up in coffee. Where's wheat? Wheat had that big run, and it's been corrective, not back above 60, but I think it's getting ready to turn again. And one of the ones that gave me a little input on thing topping out in the stocks was Amazon. We had a peak. All right, let me bring the whole chart up again. We had a rally back up to 33.86. The same thing where it closed up there. Then a few days later, the RSI rallied back to that 33.66. So it's what I call a flat. No, I'm sorry. This peak was 33.86. The second peak was 33.66. Could not, nor did not have enough momentum to get it back above 60 and create a higher price. And the bearish divergence took hold. Bearish divergences are not true reversal patterns. They're overextensions, bull divergences, and bearish divergences. But what I watch for is I watch for a high to be made and then a lower high later. Oh, what did I do there? Pushed the wrong button. Fat finger here. But even you notice what I was talking about before, what I did, this is my CFG here. Here's a price of 33.66, and this peak was 3,080, over 300 points lower. And that told me that it was going 300 points below the lows that were made back in March. This could go all the way down to 2,400, and it's already done it. We're achieving it now, so we're confirming longer term that the market is in the process of reversing. So look at a weekly, the weekly's breaking down even more because we've taken out the 2,800 and we're just working lower, and all the moving averages are still down. We're not seeing that last RSI high at 62 back in November is still holding and has never been challenged. So we're going to see some lower prices going further. And that's why I think I've been moving over more to the future side and the commodity side, because of the fact that this inflation was from real. Even looking at bonds, you could tell interest rates were coming up because the bond futures move inverse to interest rates. Just looking at a daily chart in Treasury bonds, the 30-year, look how that went up. Back the first week of March, up near 60, created a nice clean divergence, followed by the moving averages rolling over and turning down. And this top chart is just a 9 and 45 on close. It's something I teach in my basic course, the 9 and 45 period moving averages on close and RSI. But we're starting to see what I call my negative reversals that said bonds were going, bond future are going down and yields were going up. We had that inverted yield there for a while. The 2 went above the 10 for a day or two, but I think that was just a fake out. And we're going to continue to see interest rates higher. I did want to take a look at the dollar, try and get you as much as I can in 15 minutes. If the interest rates are moving up, that's positive for the dollar. You can see 9.45 just simply turned up February this year. RSI changed the range. There was one rally over the 60 level to 68, and a sell-off only came down to 40, 42. Turned up again. RSI went above 60, and the 9-period moving average of RSI went above 60, which tells me that's the start of upside acceleration. And if it breaks 40, downside acceleration. So this dollar is still strong, and it's affected currencies. It was probably the reason we saw the gold have the shakeout that it had, but gold has corrections, and when they correct, it's normally 100, maybe $125. We've had that, and I was watching for a low to be made sometime this week and to see gold bottom out. It's usually a seasonal low is usually in March. It could have come in early. We may just go back and forth and go sideways for a while like stocks did. But you need to have the seatbelt buckled. You need to have, of course, I'm going to say you need to have the RSI. I've used it for over 40 years and I trust it. So patterns don't change, whether it's an hourly chart, a daily, a weekly, a monthly. The range rules don't change, except if you're a short-term day trader, be careful with the range rules or even divergences. In the time frame you're trading, you're going to be influenced by the longer time frame. So you can get a couple shifts and back and forth in those 60 to 40 ranges, but it will stay on the daily, the weekly, and I even do them on the monthlies. I'm here to help, and I've taught for over 40 years, and most of my clients are still using the range rules, especially mutual funds when they're trying to decide which one to get into. But I want to be here to help. I'm moving more to the trading side. I'm not planning on a lot of traveling this year because I think the markets are going to be something you need to have full alert and be focused on and use stops. I see people that say, well, it'll eventually come back up and then it drops and then they buy more. Stops tell you when you're wrong, because as a trader, you don't think you're ever wrong. But with that said, Cardwell RSI at Gmail, and I can meet you on Skype, Andrew RSI, and it might say Atlanta, Georgia or Smyrna, Georgia. But get in touch with me. I'm cutting back on traveling and teaching, or not teaching, but lectures or presentations to stay here this year and focus on trading, because I want to be here to make sure you don't get caught on the wrong side. But start looking at the future side, look at the range rules, look at the moving averages, watch the prices in relation to it. But I'm here, get in touch with me. I've dealt with a couple issues this month or this year where things look like one thing and were actually totally the opposite. Let me know if I can help you. Have a good day. Stay safe.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.